find the link to crypto chart pattern guide in the description and pinned in comments below. Most people treat crypto like a lottery ticket. They rush in during the fireworks and then wonder where the money went. There is a quieter force behind every boom. Capital moves like water. Learn the channels and you stop guessing. You will learn what Web3 really is. You will learn 5 earning models inside Web3. You will learn how capital rotates during bull runs. You will learn 3 warning signs most beginners miss. Stay to the end for a simple playbook you can use right away. If you want weekly no fluff crypto frameworks, subscribe now. We release cinema quality explainers for beginners. Web3 is more than tokens and NFTs. Web3 is a structural shift in how value and control flow on the internet. In Web2, a company owns the mall. It sets the rules, controls data, and takes fees. In Web3, the marketplace runs on shared code called smart contracts. Tokens represent access, ownership, or governance. That means permissionless launch, composable projects, and incentives built into the system. Think of tokens like membership passes. Some give voting power, others give a share of fees. This change created vast opportunity. It also created new failure modes. If you do not read incentives, you will lose money to well designed illusions. There are 5 practical ways people earn in Web3. Miss which is which and you trade edge for risk. The first is trading and speculation. Trading is buying low and selling high. It includes spot trading and derivatives. Trading is fast and emotional. Markets swing violently in crypto. Many confuse momentum for safety. The second is yield farming and liquidity provision. You provide tokens to a pool and earn fees plus reward tokens. APYs can be tempting and sometimes astronomically high. Those yields are often paid with newly minted tokens. That creates inflationary pressure and hidden risk. The third is staking and validator rewards. Staking locks tokens to secure a network. Rewards are generally steadier. Staking has lockups and slashing risks if validators misbehave. The fourth is tokenized ownership and royalties. Some tokens represent revenue share or governance. NFTs can include royalties on secondary sales. The key question is whether there is recurring revenue behind the asset. The fifth is participation. Play to earn and creator economies. You can earn by playing games, building in DAOs, or creating content. These economies rely heavily on adoption and sustained demand. If users leave, the economy collapses. Each model offers different trade offs: speed versus stability, yield versus sustainability. The trick is combining models so you do not rely on a single income stream. Now we will talk about capital rotation. Capital rotation is the invisible river behind rallies. It decides winners and losers. Typical rotation follows stages. Stage 1, Bitcoin leads and draws safe capital. Stage 2, large altcoins like Ethereum pick up gains. Stage 3, DeFi and yield strategies attract liquidity. Stage 4, speculative assets such as meme coins and new launches explode. Stage 5, rotation out of profit sharing sometimes leads to crashes or consolidation. This flow is driven by yield seeking narrative shifts and retail sentiment. Most beginners buy the loudest assets at stage 4. This is when social proof is strongest. That is how fortunes evaporate. There are 3 warning signs that capital is leaving. First, rising stablecoin balances on exchanges. Second, rapid liquidity pool withdrawals. Third, volume shifts to new chains or launch pads. Ignore these signals and you risk getting trapped. Most guides miss one catastrophic mistake. They mistake token emission for real demand. A project can offer enormous APYs by minting to new tokens that lures liquidity and pumps price. When incentives stop, prices can collapse. This is an incentive mirage, not adoption. If you are in a high APY pool right now, check the emission schedule immediately. If rewards are not tied to fees or real revenue, treat the yield as temporary liquidity. Here is a practical 6-point checklist you can use in 5 minutes. Check tokenomics for supply caps, vesting, and large holders. Check liquidity depth for pool sizes and slippage. Check real usage metrics such as active users, transactions, and revenue. Check incentive sustainability to see if APYs are funded by fees or minting. Check roadmap delivery to confirm milestones have been hit. Check team transparency and token vesting for accountability. These checks are defensive. Defense wins cycles. Most people ignore these basics because they are dazzled by charts or influencers. That is how you lose your edge. Now, a simple allocation rule to prevent catastrophic loss. Use a 3 bucket allocation. Core 60% for Bitcoin and major large cap tokens you hold across cycles. Growth 30% for leading protocols, ETH related plays, and proven decentralized finance with liquidity. Speculative 10% for early stage tokens, meme coins, and launches you can afford to lose. Limit any speculative position to 2% of your portfolio. Set predefined sales targets and stick with them. Rebalance when rotation signals trigger. Discipline beats bold predictions. Here are 3 real time signals to watch for. First, stablecoin inflows to exchanges indicate cash out pressure is incoming. Second, large LP withdrawals indicate liquidity risk in specific pools. Third, volume spikes on new chains or launch pads indicate narrative rotations. When you see these, act with a plan, not panic. Combine the checklist with allocation rules and signal detection. That is your edge. You will stop reacting and start managing outcomes. Repeat this playbook. Learn the earning models, check sustainability, allocate across core, growth, and spec. Watch rotation signals and time rebalances. This turns chaotic markets into manageable decisions. You will not predict every move, but you will protect gains and participate wisely. If this helped, subscribe now. We break down crypto into simple playbooks every week. Download the checklist in the description and use it immediately. Before you trade another token, watch the next video where we analyze future possibilities and realistic expectations. It will show which signals matter most in the next bull run and how to prepare now. Protect capital, learn incentives. See you in the next one.